Hi, everyone. This is Jason Barrick of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is returning guest. He's finally coming back on after many years. He's worked in the financial industry for many years in the past. He started the TF Metals Report since around the 2008 global financial crisis. He's the host of the Sprott Money podcast as well, and the proprietor of the TF Metals Report website. Craig Hemke, aka Turd Ferguson, thank you for joining me again.
Jason, so nice to visit with you. There's so many people in this space. I don't know how we lost track. I mean, I can't remember the last time it's probably been 4 or 5 years since we've done a podcast together. And I don't know where the time goes, but anyway, it's nice to visit with you again, my friend.
Yeah, it's been many, many years. It's been too long. We'll have to get you back on routinely every couple of months. I think that would be really nice. So right now, gold and silver prices, let's just get this out of the way. We're on Monday, March 6, 2023. Paper gold prices in US dollars are at $1,846.50. Silver is barely above 21 at $21.04. I want to get your thoughts on the commitment of traders reports being delayed for a month, these shenanigans from the CFTC, the CME group. You wrote an article on this a couple of years ago on your website called Abject Corruption. I found it unbelievably it was unbelievably brutal about how messed up. Yeah, I was trying to figure out what the right phrase is here. It's kind of the dirty secret of the revolving door of corruption.
Right.
So, I mean, like this shenanigans with the commitment of traders report, do you think it fits right in with the abject corruption article you wrote a couple of years ago?
It's kind of hard to say if it goes hand in hand with that. This current situation with the commitment of traders report is frustrating. It's particularly frustrating just because of the price action of the last month. And so, where that report that the CFTC puts out once a week can be useful, at least it's never useful for trading because they delay it by 74 hours in the first place. They take the survey from all the market participants at the COMEX close on Tuesday. So that's 1:20 Eastern time on Tuesday, and then God forbid the bureaucrats and the bean counters can't crank it out until 3:30 p.m. on Friday, right? So it's already 74 hours stale. So it's never useful as a trading tool, but it can be useful just to watch the ebb and the flow and see if maybe if you know the trends and the history of how the positioning flows, that maybe that kind of helps you decipher if you're close to a bottom or close to a top, that sort of thing. This current whatever is going on with the delay of them, I've seen things, Jason. I remember Rob Keynes was talking about it being like a hack. Have you heard much about that?
So they're blaming it. They're claiming it's a hack, but it's been delayed over a month. But I've spoken with some traders who have told me that the data that was released, it looks totally modified from what it should be.
Well, and see, and that's what's frustrating because they finally, okay, everything's kind of getting back to normal or whatever. They finally put out a commitment of traders report last Friday, the 3rd. They don't give us the most recent one. They give us the first one that they missed like a month ago, which is totally useless. Yeah, I mean, why they don't like immediately catch up and then backfill with stuff that nobody really cares about? Oh, here's the one from February the 7th. Here's the one from February the 14th. Give us the current one if you're back online. And I don't know if that's, a nefarious intent behind that or if they're just worthless government bureaucrats, think of all that, it would be in line with government agencies and how the U.S. government works, right? They don't actually think like business people or traders or anybody else. They think like government employees. Well, we got to catch up and do this first report first, So I'm not sure if it's, now that they're back online, if it's, they're trying purposely to keep us in the dark about what was going on in February because, I don't think it was really probably that important because I think we can guess what was going on in February. But it does kind of get to a little bit about how maybe understaffed they are, or how they, what a odd organization the CFTC is in the first place, that this kind of thing can happen.
Well, I mean, Ted Butler was adamant that the CFTC under Gary Gensler, and he has a really checkered background. For our listeners not familiar, he was a managing director at Goldman Sachs. He was a campaign finance minister for Hillary Clinton 2016. Yep. Isn't he currently the head of the Securities and Exchange Commission now? So
that he is.
And it goes right into your article about the revolving door between Wall Street, New York City, the finance people, and DC, the DC metro area, and the regulators. And he'll probably be out in a couple years, and then he'll be looking for an even higher paying job with all that extra experience.
Right. Like Ben Bernanke going to work for Citadel, right? That sort of thing. And it's, and it's not, this is just what we deal with in our times. It's not just the banking and the securities industry where that revolving door takes place. I mean, it is every industry that is regulated now has, the regulators end up going back and taking, legal jobs within the companies that they had previously regulated. To help them get around to help them lobby and get around rules and do this other stuff. Or
get them off felony charges. Yeah, only fine.
Yeah. I mean, if you really, I saw a report once, and this kind of got me started on that. This is probably a couple of years before I wrote that abject corruption thing, but what really kind of crystallized that in my mind was a report on 60 Minutes, the CBS News program, about the revolving door between the FDA and the opioid manufacturers and distributors, and how these FDA people, they'd leave, what are some of the companies, like Cardinal Health and what's the other one, starts with an M, Mallinckrodt, I think is the other one. And they would leave there, go to work at the FDA for a while, and then go back to, the opioid companies. At the same time, they're trying to regulate, and deal with legal issues. And I mean, it's this incestuous thing between the regulated and the regulators. And obviously the same thing takes place at the CFTC and the SEC and, everything in the financial industry. And, it's a sign of the times, when there's this much money involved in everything, with money comes corruption in so many cases.
You brought up the FDA. I mean, the hedge fund billionaire Stevie Cohen, and he just bought the New York Mets a couple of years ago. He owns the whole thing now, or the majority interest now. He had FDA employees on his payroll, and he was getting the drug approval rates and all the reports months ahead of time. And he didn't go to prison. I think he paid a fine.
He didn't share a cell with Martha Stewart.
She did one trade on inside information.
Right,
I mean, that was that was a Monday or a Tuesday for him before lunch.
Right. Remember, and didn't they go after Kim Kardashian about 6 or 8 months ago for crypto stuff? But yet, Sam Bankman-Fried. It's just ridiculous. And you're right.
They pay a fine. They pay a fine though, right, to the Securities and Exchange Commission or the CFTC. They pay a large fine, but no admission of guilt.
Right. And it goes all the way, and this, Jason, I mean, it goes all the way to the top. I mean, how many billions of dollars of fines has JP Morgan paid, even just since the financial crisis? I mean, I'd say, people keep tabs of this. It's $8-9 billion. Maybe it's more than that. Now, I think it's way more than that now that I think about it. But it's like a cost of doing business. We pay the fine. Okay, we'll, write it off in a certain quarter, and then they just keep on doing it. And again, it's just a sign of our times, unfortunately. And
wasn't JP Morgan also fined a number of years ago? Maybe it was 6 or 7 years ago. We've been in the precious metal community for so long. Weren't they also fined for fraudulent data on the commitment of traders?
Yes.
And they paid like a couple $1 million fine. I think they were fined multiple times.
Multiple times for submitting fraudulent data or submitting it under the wrong class, so that having they'd have accounts that would be listed, and they'd try to put it under what should be swap dealer accounts, if you know the report, right, for people listening. And instead it ended up trying to classify it as non-reportable or small speculator, trying to hide their proprietary positions. And so again, that's all part of why, I mean, when it comes to the commitment of traders reports, I mean, there are some people that, make a living out of dissecting those damn things every week. The only reason I'm frustrated, because I just like to see what the numbers are, just the raw numbers are, to let me know who's, which side of the boat is getting heavy, because you can't trust, you can't trust, that was, you want to go back to the abject corruption thing. That was one of the things, I should say that I learned through others back in 2012, was that JP Morgan maintained all sorts of offshore accounts for trading commodities that weren't listed as their proprietary account. They were buried away in the speculator or the non-reportable category. And that was all part of evidence that I know was submitted to the CFTC as part of the silver investigation in 2012. And they never did. They just sat on it, didn't do anything with it. No, closed the investigation, said nothing happened. Of course, now we know the Department of Justice took a look at it at the exact same time period, and it ultimately indicted 5 or 6 guys from JP Morgan, including Michael Nowak, the head of their global precious metals trading division. But CFTC, the Keystone Cops, we see nothing, and so anyway, I take everything with a grain of salt is what I'm saying when it comes to the CFTC.
Well, I think Bart Chilton was the only honest CFTC commissioner. I have friends who are speaking in emails with him, who would have phone calls with him, and he was admitting this stuff. But I mean, he was only one of the commissioners, and the rest of them, especially Gary Gensler, who, given his background and how corrupt he was, I mean, there was no way there was going to be honest investigation.
Right. I never got a chance to talk to Bart. Andrew McGuire, who I consider a friend, worked with Bart. We talked to Bart all the time, worked with Bart in submitting all that evidence in 2012. Bart seemed to be an honest actor. He gave that interview, I think it was to Chris Marcus, not long before he passed, maybe 6 weeks, where he just tried to get it all out in the open, out into the air, everything that had come to pass. But the only thing I'd argue with you, Jason, was I think you used the past tense when you referred to Gensler about was corrupt.
Well, yeah, he's revolving door from the private sector back into government here in DC. He's the head of the Securities and Exchange Commission now.
Yeah. Is corrupt. Yeah, we're just having a conversation.
And the other thing is, Chilton, before he passed away, he was hired as a lobbyist for a high frequency trading group. So I mean, that just shows. I mean, they offered him a large salary, so he was a government official. And then the high frequency trading companies, so the hedge funds like Citadel and those guys, and the banks, the trade association, he was hired as a lobbyist for enormous sums of money. And this just proves the point of how things work between Wall Street, the financial companies, and the big government here in DC and the DC Metro are these large either lobbying firms on K Street, or the white shoe firms either on Wall Street or K Street in DC, and then the lawyer firms, a lot of them here in the DC Metro area that want to charge 6 or 7 figures for any type of legal work. Almost all of the lawyers used to work at, if it's a financial related entity, they either worked at the Securities and Exchange Commission or the CFTC at these firms.
And to your point, you bring up that abject corruption thing. I can't remember when I wrote that, 3 or 4 years ago. And it was out of frustration because the Department of Justice had indicted Michael Nowak and these 5 or 6 other guys. Nowak had been the head of precious metals trading, global head of precious metals trading for JP Morgan, and on the board of the LBMA in London. Those 2 jobs, that's like hand in glove kind of thing. He gets indicted for spoofing, manipulation, over the course of 8 years. He and a bunch of his traders in the precious metals. I'm reading the article about his indictment, and I read the name of the law firm that's going to be representing him, and the chief lawyer who's going to be the head of his legal team. And I went, oh my God, my head just dropped. Going back to the CFTC silver investigation and what I know about what Andy was working on and trying to get it submitted through Bart Chilton. And then eventually it all got covered up, swept under the rug, and they closed it. Well, the chief enforcement investigative officer of the CFTC during that time was a guy by the name of David Meister. And we used to joke about it, Mr. Meister, right? I mean, just kind of how I could remember his name. So anyway, 48 hours, September of 13, I think, when they closed the investigation after 5 years, 48 hours later, CFTC puts out a notice that Meister is leaving. Doesn't say where he's going. Doesn't say, it's not like, yeah, we really, great work, and now he's leaving us to go do this, that. It just says he's leaving. At the time, I thought maybe he's pissed off. Maybe he knows all this got covered up and he's leaving in frustration.
Yeah, that's not how things work here.
No, Meister shows up at a legal firm, a law firm in DC called Skadden, which is one of the biggest law firms in DC. Skadden, then, in the case of Michael Nowak, or the U.S. versus Michael Nowak, Skadden gets retained to defend Michael Nowak. And of course, his lead attorney is David Meister. So the guy goes from
he didn't even have to sit out for a couple months. He went right from the CFTC and then right to the other side defending the client against the charges.
Right. And then ends up right. So the guy that knows where the CFTC buried the bodies and all this stuff leaves the CFTC, takes a job at SCAD, and then when a JP Morgan guy who was doing all the manipulation back then gets in trouble, who do they call? The guy that used to work at the CFTC to represent him. I mean, it's just that's where
it's just becoming comical. It's just becoming comical at this point. Did you see the CEO and chairman of the board of the CME Group, which is in charge of the a lot of these gold and silver futures contracts, all these futures and options trading in Chicago? He admitted on Tucker Carlson a couple months ago, because he was talking about Sam Bankman-Fried and FTX. He actually admitted he bribes CFTC officials.
He slipped it. It was like a Freudian slip. Yeah. It was something like, well, if you're going to do business, you're going to have to bribe. I mean, you're going to have to. remember who was the tall guy on Saturday Night Live? Kevin Nealon. Remember he played Mr. Subliminal? It was his character about 30 years ago on Saturday Night Live where he would talk like that, and that's kind of what Terry Duffy did. I don't know, Jason. It makes it very difficult, especially as a silver and gold enthusiast. It makes it very difficult to not be cynical and just throw up your hands and say, this is all so corrupt. It's never going to change. I might as well, if you can't beat them, join them kind of thing.
Well,
I'll just go start trading stocks.
The people who get screwed the most in this are the mining companies. So they can't make a consistent profit because you have the paper price manipulation where the prices are barely above the cost of production most of the time. And then sometimes they go below the cost of production. And then the retail investor who watches these videos that are predicting enormous moves in gold and silver, and then they don't get them because the prices
never
are
happens.
capped.
Yeah. And to the even more dig down a level, no pun intended when we get to mining companies, but you dig down a level, think about the mining employees, the poor guys that are actually putting their lives on the line, in some place in Central America or up in the Yukon or Nevada or whatever. I mean, and they, are barely, especially in South America, maybe $5-10 a day. Where if instead a more fair price was actually discovered, maybe the mining company would be making more money, the product be worth more, and they'd pay their employees more. That's living in fantasy land, but all of this has real world impact, no doubt about it.
Well, I mean, now with all the inflation and the higher costs and metals prices not doing well, or some metals prices not doing well, you have strikes for a lot of these mines in Peru and Mexico. So we could see a lot of silver production, the base metal mines that have silver as a byproduct. We could see that come offline very soon. I think Peru already has a substantial amount of mines offline. Yeah.
And, a lot of lost production back in the COVID era, that sort of thing. The thing I'm sure you saw from the Silver Institute late last year about the supply deficit. And I probably tie this back to the CFTC and the commitment of treasury reports that we're not getting. Things are going to trade every day, right? And they go up and they go down. And, hell, we even saw a couple of years ago, things can go negative. What did crude oil go to? Negative $38 a barrel or whatever, right? So anything can happen. However, there's a thing that regarding the all-in sustaining costs and, miners having to make money, and then they start putting mines on care and maintenance if they can't, make money and that sort of thing. The precious metals markets are a different animal from not only the equity markets, but even other futures markets, because the price gets more driven or more determined by these futures prices than it is the actual delivery of the physical metal. And so in maintaining that market, there are these big banks that we call bullion banks that, operate the vaults, not so much in New York, but in London, where the metal has to be flowed at whatever price is determined through the trading of these futures contracts. If you're not flowing metal, and physically settling some metal at that price, then the price is totally illegitimate. And so as price falls, you get this point where, maybe it's the speculators, the hedge funds see the price going down and it's below moving averages and the dollar's going up and they start piling in on the short side. Well, these same bullion banks are also the ones that make the market in the futures contracts. And when there's all this heavy selling, they inevitably start to buy. And the banks actually start getting long versus the hedge funds getting short. This was a big reason why silver bottomed last fall. Because on 3 or 4 occasions via the commitment of Treasury reports, we saw the hedge funds called managed money on the CFTC reports, get short like 20, 30, 40,000 contracts net short of silver. And then the banks that were, called swap dealers, that's just another way of saying these banks, would be long 15, 20, 25,000 contracts. And what would invariably happen is, everybody's on one side of the boat, the short side, the speculator money, and they end up getting squeezed. And there were 4 separate occasions where silver just shot higher, like 10% over the course of 3 or 4 days. And it eventually, you almost kind of had like a floor to the price that it just wasn't going to go down any further. And a lot of that has to do with that cost of getting the metal out of the ground. These banks knowing that they are on the hook to deliver metal at this price. And they start worrying that they're not going to have the metal to deliver. And so they start going along themselves. It's a little bit like, gee, I'm sorry if I'm going off on a tangent, Jason, but like, did you see the story about a month ago? Trafigura? I always forget how to pronounce it.
I was going to bring that up with the bullion banks and the games that these banks play and they pay a tiny amount of fines. So there's over 500 million, for our listeners not aware, there's over $500 million of nickel that this large commodities company, they're a trading company for commodities called Trafigura. They paid for the nickel over $500 million. It was supposed to be in a warehouse. They were paying, I think, insurance fees, and the metal's not there.
And it's not there. And now they're on the hook. And it kind of has to be related to that. There was a story about a month ago that they withdrew almost all of their copper that they were storing in London. They withdrew it and took it out. Because they're like, look, we're on the hook, in part of our trading activities. We've got all these forward sells that we've got to, we promised to deliver copper over the first half of this year. And they weren't confident that they could make all those deliveries because, well, 1, copper's in short supply, but 2, it's all, there's all this scam. Who knows what they've got there. So,
and this goes back to, Craig, you've been covering this for a long time too. There's tons of these cases. I went back and found one from 2007 with Morgan Stanley with their clients over in Europe. They were charging millions of dollars in fees for allocated silver storage. And there was no silver in the vault. So there was all these lawsuits saying you were charging us millions in fees for silver that you said was allocated in storage, and you didn't have the silver when we asked to have it delivered.
Right. And aluminum was another one. That they did the same thing on. It had to pay a couple billion. I don't even know what it ended up being that they had to pay in fines. Charging customers storage fees and insurance costs on metal that wasn't even there. Which now here I go on another tangent, Jason. It's a lot like those what I think are scams, the unallocated accounts that are run by mints and bullion dealers and banks.
Even Kitco has that, right? And Perth Mint.
Right. Where I'm not to speak to any of them individually, because who knows, but as a group, I think anybody that's invested in that sort of thing should be extremely cautious, because just even on the surface of it, because if they say, well, let's see, in an allocated account, here at our whatever organization, your fees a year are going to be 1%, let's just say. Okay. Or you can sign up for an unallocated account and the fees are 0.1%. But I assure you, the metal is still there. If you ever need it, you sign, here and we get it to you and all that kind of. Well, no, wait a second. If the metal's actually there, why are the insurance and storage costs 90% less? Right? I mean, we can kind of connect the dots here. And that's always been just another one of these, I don't know, scam and fraud, too strong of a term. But this, it's a way of maybe of alchemy in a sense of precious metal to say, yeah, we'll give you the exposure to price through our unallocated program. And if you ever actually want real metal, then you can come here, you can sign, and 60 days later, it says in the fine print, we'll get the metal to you. And that's all well and good as long as you're the only one that shows up wanting that that metal in 60 days. If everybody in the unallocated program shows up at the same time, like I'll run on the bank, well,
well,
I guess you ain't getting their metal.
I know you've interviewed Ned Naylor Leland, former gold fund manager. I'm not sure if he's still a gold fund manager, but
yes, he is.
CNBC brought one of Bob Pisani, I think, into the GLD vaults, right? And they were showing the bars, and Ned Naylor Leland was like, when they were showing the serial number on the bar that the talking head on TV picked up, he was like, "That's my gold bar."
Yep. And it was not supposed to be part of the GLD inventory. And instead, it's just all kind of commingled. Guy that does a lot of great work covering this is Ronan Manley at Bullion Star. Have you ever talked to him?
Oh, I read his articles all the time. Yeah.
Jason, I tell you what, with the analysis that you do and your analytical mind, I think you and Ronan would have a fabulous conversation about this stuff. And he does a great job of really writing extensive articles, but keeping track and calling to the carpet just the lies of the LBMA about, how much metal they actually have and how much of it is unencumbered and actually has, kind of like a clear provenance that can be used for delivery and that sort of thing. It's like all the silver they claim to hold, in the LBMA vaults in London. But of that, the vast majority of it is pledged already, to the SLV and the other ETFs and that sort of thing, leaving, just a fraction of what they claim to have that's actually there to be delivered versus, by these banks delivered out, to customers. So the whole thing is, and this is what's so frustrating and hard not to get cynical about, because the whole thing relies on leverage and hypothecation and rehypothecation and just-in-time delivery and confidence. It's a confidence game.
Well, there's limits to there is limits to the paper price manipulation, Craig, because they do have to deliver physical silver to the industrial end users,
yes.
Excuse me. So like the investors, the silver investors. So if you're a money manager and you want a ton of physical silver delivered from a COMEX contract, they're going to make you jump through all these hoops and all these extra fees. And you might have to wait at one point if there's a huge delay in silver supply, you might have to wait 6 months. I mean, I've heard money managers many years ago, they had to wait 6 months for 1 ton of physical silver delivery from a COMEX futures contract. But if you're an industrial end user, I mean, you're going to get priority at the front of the line. Or if you're a central bank, I mean, the central banks right now are buying gold tonnage hand over fist. They're not buying U.S. treasuries. They're buying physical gold.
We just saw something today. Singapore made their first announcement of their gold reserves in a year and a half, and suddenly it increased by 44 metric tons. I mean, and the amount for the last couple of years has been the largest central bank gold buying since 1968, 1969. So yeah, that trend is significant. And the other thing that's significant that could impact particularly silver as the year goes along. I keep referring back to London and the LME. But there are some great charts out there. Anybody can, find them just in Google Images and stuff of the combined vault in London or globally of copper, zinc, nickel, lead, aluminum, all these base metals, and what was known above ground stocks in these vaults and how it has just declined steadily to where it is now. And it's like maybe a fraction, 10, 15% of what it was 10 years ago.
China's drained it.
Yeah, there's a real potential there. You mentioned what happened in nickel, that we could finally get. I hate to use the word delivery failure because now I sound like we said, like these guys.
They just cash settle. I mean, they have so many legal loopholes though on all these things. I mean, in 2011, there was tons of stories on this in Zero Hedge. Weren't they trying to cash settle a bunch of people for 60, 70, 80% premiums?
On COMEX?
Yeah, for futures contract.
There are all kinds of. I don't know, not a lawyer. I don't know all the legalese of the little back doors that they have. I do know there's precedent. One of the greatest stories I remember. I think I first heard about this from Ted Butler 10 or 12 years ago. The Maine potato contract used to be a big futures contract. Just like sugar or cocoa or anything else. You could do Maine potatoes. And this is like in the mid 70s. J.R. Simplot was the big potato guy in Idaho. And they got, I don't know how the delivery and the default force majeure all came about. But eventually the the main potato contract had to just simply close out and cash settle at the previous night's close. And then it just went away. And it was a story, in the Wall Street Journal, a couple of paragraphs for a couple of days, and then it just was gone. And maybe that's eventually what will happen to some of these other futures contracts that are, rely so heavily upon leverage of physical metal. There'd be maybe, and I try not to sound hyperbolic, so I hate to say silver. But for the sake of this example, at some point there is a silver shortage or a copper shortage or something, and there's delivery failures somewhere, not on COMEX, more likely in London or somewhere else. And all of a sudden there's no metal to be delivered at the futures contract price. So what would happen? Well, the precedent is that main potato thing, last night it was $4.80 here in copper. And so we're just going to cash everybody out at 480. And now the new price is like 10.
Wouldn't that blow up the derivatives though that these bullion banks and hedge funds are trading? So they're trading insane amounts of derivatives on top of the regular futures contracts and the amount of metal that's been mined. So the amount of derivatives for silver and for gold are many orders of magnitude compared to the actual metal that's mined each year. Yes, absolutely. And we're talking a major financial event. But again, these are all too big to fail banks. And, the Fed already has a $8.5 trillion balance sheet. What's, another 10 or 20 billion for some bank that's underwater in COMEX derivatives? I don't know. We're kind of speaking in hypotheticals here, Jason. With the main thing for precious metals investors, what I've discussed on my site now for a dozen years is the idea that price is determined. It's the futures tail wags the spot dog. And you can see it every day on the COMEX. The COMEX is trading paper. Price might have been solid all overnight, all the way through Asia, through the London session. And then COMEX trading starts and boom, down it goes. And it's all this derivative trading. At some point, and it will have to be because of the lack of physical metal, in a classic bank run type thing, at some point, there's just not enough physical metal left to settle trades at that derivative discovered price. And then that's when that system falls apart. And just like the London gold pool fell apart 50 years ago. And then we see what happens next. Now, is that the managed retreat scenario that James Turk of Gold Money has been talking about for years? Because I hear a lot of silver bears say that silver's going back down to 10 for a certain amount of time soon. And it's like no silver producer on the planet, not even Silvercrest Metals or any of the really low cost guys can produce silver around 10. So, I mean, like silver at 15, silver at 14 or 15 is going to bankrupt a lot of these primary silver miners. I mean, the costs that we're seeing come out lately, Craig, with Pan American Silver, their costs are up a lot. I put an article out on this for my paying customers, my patrons, that Pan American Silver's grades in under 10 years, they've been cut in half at their average silver grades. Yeah. So, I mean, like the costs for a lot of these miners, people saying $10 silver. I mean, maybe we, like you said, we did see oil futures go negative. I mean, if it does go to 10, it would be the shortest amount of time possible because, I mean, even at 14, 15 silver, it's just not economic anymore. And you get the situation like we got the last time prices went down that far. You get, okay, they might be able to trade the paper there temporarily, but you aren't going to get your hands on any physical at 14. Yeah, probably like $12 premiums, $12 ounce premiums. Exactly. So, they can trade their phony baloney plastic banana futures contracts if they want. But I would even, like I said earlier, this gets to if there is any value to those commitment of treasury reports, it shows you on a weekly basis this change where the only way price falls like that is the hedge funds are dumping all of their longs and building up a massive short position, which then is counterbalanced by these swap dealing banks, the bullion banks, covering all their shorts and going massively long because they have to. And that just provides kind of a natural floor at that, whatever that physical price, that, minimum physical price is. It's like, Jason, back between 13 and 18, silver kept going down to about $14. It would never go any lower.
all through the operation twists, and all the Fed rhetoric and all this kind of stuff, it would kept bouncing off of 14. And it was kind of like what happened this last fall, where it would dip below 20 and they'd try to jam it down to 18. And then you get this short squeeze right back up above 20. And then here came all the specs again, jamming it back down, jamming it, and boom, in 3 days, it'd be back over 20 again. And okay, well, what's significant about 20? Well, you just mentioned it. You take about the 7 largest primary silver producers off their most recent results, and all of them are pretty damn close to a $20 all-in sustaining cost. So it doesn't mean that, that all the markets just completely melt down and the S&P goes to 2,800 or something and everything getting liquidated and the kitchen sink and all that, all those metaphors. Then, okay, so maybe they dump silver to $14, like it went to 12 for a couple of days in March of 2020. But it ain't going to stay there very long. And
that would be a buying opportunity then too.
Right. And again, you're not going to be buying, you're not going to get your hands on any physical silver at 14. There's just not enough of it to go around.
Well, and then you try to find the low cost producer then that could actually survive a scenario like that.
Right.
That doesn't need to go get capital from either cash or take on a bunch of debt, that can survive that scenario for a short amount of time.
Right. Exactly. So, and again, I value the wherewithal and the fortitude of anybody that makes their living as a trader. Right. I couldn't do it. I couldn't possibly be a professional trader. It takes great self-confidence and a courage or conviction to be a professional trader. The problem with professional traders, though, they have such great confidence, they think they know everything. And they have 100%. It's almost like doctors. The doctor's been told their whole life they're the smartest people in the room. And so therefore you can't talk to them about anything without them thinking they're a complete expert on everything because they've been told their whole lives they were smart and successful traders.
Some of them just stare at charts though, Craig. And so like I had people who were armchair quarterbacks telling me that natural gas was going to stay below 2 for a long period of time. But meanwhile, I was interviewing all these oil and natural gas experts that cover a lot of these oil and natural gas stocks for a living, the Canadian and American producers, and the lowest cost producers can't make any money at 2. So they were going to start cutting off supply. So if natural gas can't stay at 2 here in the United States, it's just uneconomic. So you're going to have all the supply come offline soon.
And that's which gets to your point. You can't just simply look at a dot on a screen, go through a little trading and think all markets are the same and they're all determined. They're not. Okay. Not even getting into, the dirty dealings of the bank trading desk and that kind of stuff. It's just that every market has its own different structure. And what's so unique about gold and silver, again, you can look at these CFTC reports of S&P futures, bond futures, Forex, other commodities. Go down the list. And you get these reports from the CFTC showing the market breakdown, commercials versus speculator. And they're all pretty much even on both, there's commercials that are long and short and speculators long and short. Only gold and silver have a structure where the commercials, the banks are always or almost always net short and the speculators are long and it just ebbs and flows.
But the bullion banks still need the metal though, right? So they still have to deliver the metal for silver to the industrial end users. Yes. And for physical gold tonnage, the bullion banks are getting large commissions to move that tonnage to the central banks.
Yes. And if we're going to cut them some slack for the way they trade, it's because they are sitting on, or at least they should be, if they actually have it, stockpiles of metal for that future delivery. And so therefore they hedge. They have to hedge. They have to maintain some short positions against their stockpile of physical metal. In fact, in the communication once or twice that I've had with the CFTC complaining about bullion banks with showing on the delivery reports positions that are well in excess of the stated position limits, the CFTC will tell you, well, no, they have bona fide hedging exemptions. And so they can, where you and I, can have 3,000 contracts, the banks can have 6, 8, 10,000 if they want, because it's a bona fide hedge. So, that gets to, again, why then do they eventually go long? Because again, they know that they've got to get their hands on metal, and as price is falling, it's going to make harder and harder to get your hands on it. And that's how that all kind of sorts itself out. Anyway, getting to the end where we were about the traders, look, I have nothing but respect for people that make a living trading, but where it gets lost sometimes is the peculiarities of each individual market, are all different. And it really takes a combination of, okay, look at the chart, see where price is relative to key technical indicators and stuff like that. But you also got to know the fundamental stuff about each individual market.
Well, especially
Otherwise,
if the commodity is below the cost of production, it's not going to
right.
stay there
Yep.
for a long period of time, maybe a couple quarters, at most, maybe 6 to 12 months or something like that. You're going to have a lot of supply come offline. I mean,
Yep.
demand is eventually going to rebound, especially if these governments are promoting ESG spending, because silver is going to be needed for electric vehicles. Silver is going to be needed for solar panels, all these things.
Yep, no doubt about it. And, and that's one last thing we didn't really even get into. We talked about it briefly. We were kind of going there. It's this notion that given the shortages, shortages means it's imminent, it's happening right now. Given the declining stockpiles of above ground metal globally for all these base metals, let's just follow the trend as we go along this year and see if some of these bigger companies don't end up securing their own supply. I mentioned Simplot and his potatoes. Part of that driver back in the 70s, I believe, was McDonald's was their biggest customer, and McDonald's eventually just bought their own potato farms, didn't need them anymore, right? So if you are Elon Musk or some Indian solar panel company or something, and you're worried about getting your hands on silver, you can't make whatever you're making without that input, that particular product. Well, then maybe for damn sure you might want to go secure as much of that product, or your own supply of it. So let's watch and see if not just silver, but if, some of these companies start buying copper mining organizations, or, company, there are a lot of good companies out there that mine zinc and other base metals. Be interesting to see if that isn't a trend that kind of starts to develop as this year goes along.
Elon Musk has talked about that with lithium mines for electric vehicles, but we'll see. I actually, as we wrap things up here, I want to get your thoughts on what Peter Hambro, for our listeners who are not aware, about a couple months ago, he's a former London bullion banker. His family was in banking in London for many generations. He was talking about gold and silver price manipulation and derivatives. So I was shocked to hear a former London bullion banker. And I know we've had other bankers out of London like Alistair MacLeod for Gold Money and also Mario Monaco talk about this too. I was shocked to hear him, though, just be very candid about manipulation for gold and silver futures and derivatives.
Yeah. Andy McGuire telling me those stories a decade ago. How, they just would go to the bar and chortle about how they, the people they screwed that particular day. And again, it's look, I don't want to make it sound like it's easy to do, but it's pretty damn easy to do, especially in a market like silver that is just tiny. And I know we've got, the indictments and the convictions, but if you watch this stuff on a day-to-day basis, you can still see it going on. The spoof orders come in, above a certain level. If you act fast enough, if you've got that level 2 or level 3 kind of quotes, you can actually see still. I've had people, tell me this, they send me screenshots, that sort of thing, where these orders just flash in, at 21, 25 in silver, all of a sudden there's 10,000 contracts for sale or something that just flashes in. And price kind of gets capped and rolls back over. I mean, it is such a small market that I think silver is the most manipulated market in the world. And it still continues to this day. And it's not, I don't know about the, to the extent, I really don't think the central bankers give a shit anymore. In fact, a guy I know named Tom Luongo makes an excellent point that the ECB in particular could really use a higher gold price now, because gold's the only asset they have on their balance sheet, and all their bonds are going down in value and they're soon going to be insolvent. So they need a higher gold price. So I'm not sure it's, this government edict trying to cap price anymore as much as it is just greed. If you're a bank trading desk and you've got monopolistic power to control the price, through pressing some buttons, you're going to do it, especially if the regulators, as we mentioned, are captured and looking the other way.
The European Union and the European Central Bank would have flipped then, because there was a book out, I think, many years ago, almost a decade ago, by I think it was Dimitri Speck, and he was writing about gold market manipulation. He was like, the European Union and the European Central Bank officials were on the phone daily with the U.S. Treasury and the Fed, telling them to manipulate the gold price back down. This was 2011 during the Greece crisis and the pigs.
Yeah, to Tom's point, it's a different world now, and I don't know if he's right or wrong, but I thought it was definitely something to think about, that all of a sudden there might be some real value. I just saw a story last week, Jason, about the Bundesbank is just taking huge losses on their bond portfolio as rates are just, skyrocketing in Europe. Well, how do they counterbalance that? To stay day-to-day solvent. If the only asset that the Bundesbank has maybe is some gold, or certainly the ECB, if the only asset they have is gold, well, then maybe they need a higher gold price. I don't know. It's all stuff again, this is very interesting period of time that we're in here in 2023 and 2024. Will the Fed pivot like they always have in the past? All these metal shortages. There's a lot of different things going a lot of different directions. And if anything, it's not boring.
I agree. And these countries that, like Singapore and others that are buying large amounts of physical gold tonnage, they're sacrificing a 5% yield. They could buy U.S. Treasuries and they can make a 5 or 6% yield on their U.S. Treasuries instead, and they're not doing it. So instead, they're buying physical gold. That's
something I remember back in the day when I was a stockbroker 30 years ago. That's what people would do. They'd say, you know what, I'm going to take some money out of the stock market for now, and I'm going to stick it in a CD at 7%, or Treasuries at 5%. And you used to have that kind of a rotation. Now there's just so much money everywhere. Trillions and trillions of cash has been created that you don't have that, or at least we haven't seen it yet. That rotation of, I think I'll get out of stocks for a while and, take them out. What will probably happen, Jason, is eventually that rate will get short enough or high enough in the 6-month T-bill, that sort of thing, that you'll start to get that rotation and you'll get bids for treasuries, and that'll start bringing that yield down some. And that'll be that inversion that currently will start to flatten out a little bit. And, a lot of folks think that that's the sign that the recession has begun, when that inversion starts to go away. So,
or the Fed cuts rates, and it won't be that bullish for stocks because the Fed's going to have to go in there and be the buyer of last resort for U.S. Treasuries and government municipal bonds.
Yep. No, again, I agree with you there, brother.
Okay, Craig. Well, I really enjoyed our discussion today. We'll definitely have you back on in a couple months for another update on gold, silver. Thank you again for your time. And if my listeners want to follow you on Twitter or check out the TF Metals report, how do they do so?
Yeah, Twitter's fun. I like to put stuff on there. At TF Metals is all. You can find me there. The site is we had to go to a subscription base about 10 years ago, but it's affordable. I mean, it's only $15 a month. And what I do there every day, I write a report every morning about what's going on in the world. I record a podcast every afternoon, kind of summarizing the events of the day and what we're going to look forward to the next day. Makes me basically everybody's eyes and ears, so that let me lose sleep and lose my hair and age and wrinkle and everything all this, so everybody else can just check the site a couple times a day and I'll let you know what happens. So anyway, it keeps me busy. But tfmetalsreport.com is where you can find it.
Do you have the Turd Ferguson cowboy hat? Do you actually have that giant foam cowboy hat?
I still have a couple of them in my closet. Yeah. Yes,
That's cool.
I do.
Maybe you'll have to take a profile pic of that and put it on your Twitter for Halloween or something.
Maybe.